Welcome to another deep dive. You know, with the 2024 election in full swing,
Mm-hmm.
we just had to dive into a fascinating relationship you might not expect.
Oh, really?
The link between those infamous October surprises
Yeah.
and what happens in the stock market.
Oh, interesting.
Right.
Yeah, definitely a side of elections that often flies under the radar. But it can be incredibly revealing
Oh, absolutely.
about how intertwined politics and finance really are.
Absolutely. Our guide for this deep dive is an analysis titled 2024 October Surprise Playbook. It's by Lucas Downey for mapsignals.com, dated October 3, 2024. So let's unpack this. First things first. What exactly do we mean by an October surprise?
Hmm. Essentially, it's any significant event, often unexpected, that pops up in the weeks leading up to a presidential election.
Mm.
Think of it as a wild card that has the potential to shake things up, whether in the polls or the public consciousness.
And history is full of them, right?
Oh, yeah.
I mean, our source points to a whole bunch. But one that really jumped out at me was the 2008 financial crisis hitting right before the election. Talk about an October surprise with immediate economic impact.
Absolutely. And that example highlights how these events aren't just political theater.
Right.
They can have a very real impact on people's lives, their finances,
Yeah.
and their outlook on the future, which in turn influences how the markets react.
Okay, so we've got these October surprises popping up,
Yeah.
injecting uncertainty
Yeah.
into an already tense time. How does the stock market, this massive collection of investors and algorithms,
Yeah.
typically respond?
That's where it gets really interesting. So the playbook delves into stock market data, going all the way back to 1928. And a fascinating trend emerges, particularly in the S&P 500, which, as you might know, tracks a broad spectrum of large U.S. companies.
And what does this historical deep dive reveal? Are we talking crashes, spikes?
Okay.
Give us the inside scoop.
Since 1928, the S&P 500 has shown a tendency to dip in October of election years. Now, it's not a catastrophic plunge, but a consistent dip nonetheless, averaging around 0.3%. But here's where it gets even more intriguing.
Oh, I do love a good plot twist. Lay it on me.
This dip isn't evenly distributed throughout October. The playbook highlights that the most pronounced drop tends to occur within the first half of the month, from October 1st to 15th,
Okay.
with an even steeper average decline of 2.83% since 1988.
So almost like the market takes a collective gasp, holding its breath in anticipation of what might happen on election day. I can see why they call it a playbook. It's like the market has its own set of plays for this time of year. But what's the driving force behind this front-loaded dip? Is it purely driven by these October surprises? Or is there something else at play?
Well, the October surprises, they certainly play a role, right, injecting uncertainty into the mix.
Right.
But it's also about investor psychology and this inherent tension between potential risk and reward.
Mm-hmm.
Remember, during an election year, there's always that possibility of policy changes,
Right.
shifts in the regulatory landscape,
Right.
all of which can impact businesses and the overall economy.
So investors get a bit jittery, maybe hit pause on some of those bigger investment decisions until things become a bit clearer after election day. It's like everyone's waiting to see which way the wind will blow before making their next move.
Exactly. And that hesitancy, that slight pullback from the markets, is reflected in that early October dip we're seeing in the data.
Okay.
But here's where it gets even more fascinating.
Okay.
The playbook doesn't just stop at highlighting the dip.
Right.
It also explores what tends to happen after the election dust settles.
Okay, so you've piqued our curiosity. Fill us in. Does the market stay in a slump? Or does it find its footing again?
Historically speaking, the stock market tends to perform quite well in November and December of election years. It's like this collective sigh of relief washes over the market, regardless of who wins the election.
So no matter who occupies the Oval Office, the market seems to find its happy place once the uncertainty of the election is behind us.
Precisely. And this positive trend, it's particularly pronounced when we look at small cap stocks.
Okay.
Those companies with a smaller market capitalization, often seen as representing growth potential.
Right.
The playbook points to the Russell 2000 index, which tracks these smaller companies. And it shows an average surge of 7.3% in November and December of election years.
Wow.
That's a significant jump, especially when compared to the early October dip.
7.3% is nothing to sneeze at. So we've got this intriguing pattern of an early October dip, followed by a potential surge in the months after the election, especially for those small cap stocks. But the million-dollar question is, can investors actually capitalize on this historical trend?
That's the question, isn't it? And the playbook. It offers some compelling food for thought,
Okay.
urging investors to, and I quote, "Don't follow the headlines. follow the money.
Okay, I love a good catchphrase as much as the next person. But let's break that down. What does it mean to follow the money in this context?
It means looking beyond the noise of election season. You know, that constant barrage of polls, predictions, and punditry?
Right.
It can be overwhelming,
Yeah,
creating a sense of chaos and uncertainty.
sure.
But beneath all of that, institutional investors, those big players who manage vast sums of money,
Right.
they're making strategic decisions
Yeah.
based on their analysis and outlook.
So instead of getting caught up in the day-to-day drama of the election cycle, we should be paying attention to what these institutional investors are doing with their money. It's like peeking into their playbook, getting a glimpse into where they see potential opportunities.
Exactly. And one way to track these big players is through something called the Big Money Index, or BMI. Think of it as a gauge of institutional buying pressure.
Okay, so the BMI gives us some insight into the actions of these market movers and shakers. And what's the BMI telling us right now? Is it signaling a continuation of this historical pattern? Or are things shaking up a bit differently this election year?
That's where things get really interesting.
Yeah.
The playbook points out that the BMI is currently showing
Ah.
a strong interest in smaller companies,
Okay.
echoing that potential for a post-election surge we were talking about earlier.
So if we're connecting the dots here, it seems like these institutional investors might be looking past the October jitters, anticipating that November-December upswing, and potentially seeing opportunities in those smaller companies, the same ones tracked by the Russell 2000.
Precisely. Yeah, it's like they're playing a different game. One that's less about the daily news cycle and more about recognizing long-term trends and potential. They're not necessarily picking winners and losers in the political arena, but rather positioning themselves to benefit from market movements that often follow an election.
That's a really interesting perspective. It's almost like they're saying, okay, the political show is entertaining and all, but we're focused on the bigger picture, the underlying market forces.
Exactly. And that's a powerful takeaway for any investor, regardless of their experience level.
Right.
Don't get so caught up in the headlines that you miss the underlying trends and data.
So to sum it all up, we've learned that October surprises are a real phenomenon, capable of injecting uncertainty into the market and potentially impacting investor behavior. But we've also uncovered a fascinating historical pattern. This tendency for the market to rebound in the months after an election, especially for small-cap stocks.
Right.
And perhaps most importantly, we've been reminded that keeping an eye on what those big institutional investors are doing, following the money as it were, can be a valuable strategy, particularly during times of heightened uncertainty.
Absolutely. And as we navigate the rest of this election year, with all its twists and turns,
Yeah.
remember that understanding these historical patterns and keeping a cool head amidst the storm can be incredibly valuable.
You got that right. As always, thanks for joining us for another deep dive. Now we want to hear from you. How does this new understanding of election year market patterns change how you approach investing? Until next time, keep learning, keep exploring, and we'll catch you in the next deep dive.